Gold, a beginner's guide to the glittering world of finance. Gold has fascinated civilizations for millennia, not just for its beauty, but for its economic and financial significance. For those new to the world of finance, understanding gold's role can provide valuable insights into both the history and mechanics of global economies. This article will explore why gold is more than just a shiny metal and how it plays a critical role in investment portfolios and financial strategies. What makes gold special? Gold is not only a valuable material, but also a remarkable element with several properties that make it stand out in the world of finance and economics. Here are the reasons why gold is considered special across various dimensions. 1. Physical and chemical properties. Gold is incredibly durable and malleable. It can be melted over a common flame, making it easy to work with, unlike many other metals. Gold does not rust, tarnish, or corrode, which means it can last forever without losing its luster. This quality makes it an ideal material for jewelry and coins, which need to endure handling and exposure over long periods. 2. Scarcity. Gold is rare enough to be valuable, but not so rare that it is only a collector's item. Approximately all the gold ever mined would fit into a 20-meter cube, illustrating its rarity. This scarcity plays a fundamental role in its high perceived value and has been a significant factor in its use as currency throughout history. 3. Global acceptance. Gold is universally accepted around the world as a form of payment and a store of value, which has been true throughout history. This universal acceptance is crucial during times of geopolitical instability or economic turmoil when trust in governments or financial institutions can waver. 4. Historical significance. From ancient Egyptian pharaohs to modern central banks, gold has been an integral part of economic systems. Societies across the globe have used gold for significant transactions and to symbolize wealth, power, and divine grace. For example, the tomb of Tutankhamun was discovered with more than 110 kilograms of gold inside, indicating the metal's value even in ancient times. 5. Financial stability. Economically, gold is often seen as a safe haven during times of financial uncertainty. Unlike fiat currencies, which are subject to inflation and can be devalued, gold maintains its value over time. This stability is highly valued, particularly in countries experiencing hyperinflation or economic crises. 6. Non-correlation with other assets. Gold often moves inversely to stock markets or economic conditions. When stocks decline, gold prices usually rise, making it a valuable hedge against market volatility. This non-correlation helps investors diversify their portfolios, reducing overall risk. 7. Liquidity. Gold is highly liquid. This means it can be bought and sold with relative ease on the global markets. Gold's liquidity is evident during periods of crisis when it can be quickly sold or traded for goods and services. 8. Cultural and symbolic value. In many cultures, gold holds significant symbolic value. It is often associated with purity, value, and achievements. For example, gold medals are awarded for highest honors in competitions like the Olympics, symbolizing the peak of achievement. Example of gold's unique role in modern times. During the Eurozone crisis in 2011, many investors and European citizens turned to gold as a safe asset because it was considered more stable than the euro, which was experiencing significant volatility. This shift underscored gold's role as a crisis commodity, capable of retaining value even when other forms of currency are under threat. These distinctive characteristics make gold a unique asset in the financial world, transcending its status as just another commodity to become a critical tool in financial planning and economic stability. Gold in the economy, an overview. Gold's role in the global economy is extensive and multifaceted, impacting various sectors from finance to manufacturing. Understanding how gold operates within these realms provides a clearer picture of its importance beyond mere decoration or currency. 1. Central banks and gold reserves. Central banks around the world hold large quantities of gold as part of their foreign exchange reserves. This gold serves multiple purposes. It acts as a store of value, provides liquidity in times of crisis, and instills confidence in the stability of a nation's financial system. For instance, the U.S. Federal Reserve holds over 8,000 tons of gold, making it one of the largest stockpiles in the world. This gold is not just a monetary asset, but also a symbol of economic strength. to gold as a hedge against inflation and currency fluctuations. Gold is often seen as an inflation hedge because it tends to maintain its value even as the purchasing power of fiat currencies declines. Throughout periods of high inflation, such as the 1970s, or during times of currency devaluation, gold prices have historically increased. This characteristic makes gold a favorite investment during uncertain economic times. Number 3. Gold and the jewelry market. The demand for gold in the jewelry industry significantly affects global gold prices. Countries like India and China are leading consumers of gold for jewelry, particularly during festival and wedding seasons. In these cultures, gold is not only a decorative item but also a crucial form of financial security and a symbol of wealth and prosperity. For example, during Diwali, India's demand for gold typically spikes, influencing gold markets worldwide. 4. Industrial demand. Beyond its aesthetic and financial applications, gold has important industrial uses, especially in electronics and dentistry. Gold's excellent conductivity makes it an ideal material for precision electronics, where reliable, corrosion-resistant connections are crucial. Although the amount used in each device is minute, the sheer volume of electronics produced globally translates into a significant demand for gold. Number 5. Investment demand. Investment demand through exchange-traded funds, ETFs, coins, and bars also plays a critical role in gold prices. During economic downturns or when stock markets are volatile, investors often turn to gold as a safe haven, which can drive up prices. For instance, the launch of the first gold ETF in 2003 made gold investment accessible to the general public and significantly increased gold demand. 6. Recycling and sustainability. Gold is highly recyclable, and a significant portion of the market's supply comes from recycled sources. Old jewelry, electronic components, and even dental fillings contribute to the supply, reducing the need for mining and lessening the environmental impact. The recycling aspect of gold underscores its enduring value and contributes to its sustainability profile. 7. Global trade and political stability. Gold also plays a role in international trade and political stability. Countries with large gold reserves can use these to stabilize their economy or to negotiate trade agreements. During political or economic crises, gold reserves can act as a financial lifeline. Through these diverse roles, gold remains not just a tool for personal investment, but a crucial element of the global economic infrastructure. Its ability to function as a financial safeguard and its applications across various industries make it an asset of unmatched versatility in the economic landscape. Investing in gold. Investing in gold is a popular strategy for both diversifying investment portfolios and protecting against economic uncertainty. Gold's unique properties and historical performance make it an attractive option for many investors. Here are some of the key ways people can invest in gold, along with considerations and strategies for each method. 1. Physical gold. Investing in physical gold involves purchasing the metal in the form of bars, coins, or jewelry. This is often considered the most direct way to invest in gold. Physical gold ownership provides a sense of security as you have actual possession of the asset. However, it also requires safe storage solutions, such as a home safe or a bank safety deposit box, and insurance to protect against theft or loss. Additionally, physical gold can incur higher premiums above the spot price, reflecting fabrication and distribution costs. Example: many investors prefer gold coins issued by governments, such as American Gold Eagles or Canadian Maple Leafs, because they are recognized worldwide for their purity and are easier to trade. 2. Gold ETFs, exchange-traded funds. Gold ETFs are a convenient way to invest in gold without dealing with the hassles of storing physical metal. These funds hold large amounts of physical gold and issue shares that are traded on a stock exchange, similar to stocks. The price of ETF shares tracks the price of gold, minus fund management fees. This method offers high liquidity, meaning investors can buy and sell shares easily during market hours. Example: the SPDR Gold Shares, GLD, is one of the largest gold ETFs and provides a good example of how gold ETFs offer investors exposure to the movements in gold prices without the need to physically hold the metal. Number 3. Gold mining stocks and funds. Investing in gold mining companies or mutual funds that hold portfolios of gold stocks is another way to gain exposure to gold. These stocks tend to be leveraged against the price of gold, meaning that if the price of gold goes up, the earnings of the mining companies may increase significantly. However, this investment is also subject to the risks associated with the mining industry, including operational risks, regulatory issues, and environmental concerns. Example: shares in major gold mining companies like Newmont Corporation or Barrick Gold Corporation can provide substantial returns, especially when gold prices are rising. However, investors need to consider factors such as production costs, management effectiveness, and geopolitical risks where mines are located. 4. Gold futures and options. For more experienced investors, gold futures and options offer a way to speculate on the price of gold without actually owning it. Futures contracts are agreements to buy or sell gold at a future date at a predetermined price, which can help manage price risk. Options give the right, but not the obligation, to buy or sell gold at a specific price before the option expires. These instruments are traded on commodities exchanges and can offer high leverage, but they also carry a higher level of risk and can be complex. Example: futures and options are typically used by more sophisticated investors who are comfortable with potentially high levels of volatility and have the capability to absorb possible losses. Number 5. Digital gold. In the era of digital finance, digital gold products allow investors to buy gold online and have it stored in secured vaults by the providers. Investors can buy fractions of gold, which makes it more accessible to those with limited capital. This method combines the security of physical gold with the convenience of digital trading. Example: platforms like Bullion Vault or Gold Money offer ways to invest in gold digitally, providing liquidity and storage without the hassle of handling physical gold. Conclusion: each method of investing in gold has its own set of benefits and risks. Investors should consider their financial goals, risk tolerance, and investment timeline when choosing how to include gold in their portfolios. Whether seeking stability, protection against inflation, or speculative opportunities, gold remains a versatile and valuable investment. Examples of gold's impact. Gold's influence extends across economic, cultural, and technological realms, having a significant impact on various aspects of society and markets. Below are expanded examples that showcase the impact of gold historically, economically, and in modern times. 1. Historical impact: the Spanish Empire. Example: during the 16th century, the influx of gold and silver from the New World into Spain played a pivotal role in global economics. The Spanish Empire's wealth surged as ships loaded with precious metals arrived from the Americas. This abundance of gold and silver not only made Spain one of the wealthiest and most powerful nations of that era, but also contributed to the Spanish price revolution, a period marked by widespread inflation due to the increase in the money supply. This example illustrates how gold can alter the economic fortunes of an entire nation and affect global trade and economics. 2. Economic stability, post-World War II reconstruction. Example: after World War II, the Bretton Woods system was established, creating a global financial system that linked Western currencies to the US dollar, which itself was convertible to gold at a fixed rate. This system stabilized exchange rates and facilitated post-war recovery and growth by providing a predictable monetary environment. Gold, serving as the backbone of this system, helped to instill confidence in the currencies tied to it, demonstrating its role in providing economic stability. Cultural impact: India's gold market. Example: in India, gold is not just a commodity, it is deeply embedded in the culture. Gold is central to various festivals like Diwali and Dhanteras, and weddings, where it is customary to gift gold jewelry. This cultural importance drives significant demand in the global gold market, particularly affecting prices and gold trade balances. The cultural affinity for gold in India exemplifies how traditions can influence national economic behaviors and have a broad impact on global markets. 4. Technological and industrial uses. Example: gold's excellent conductivity and resistance to corrosion make it an indispensable material in high-tech industries, especially in electronics and precision engineering. For instance, gold is used in the manufacturing of connectors, switches, and relay contacts in everything from consumer electronics to sophisticated spacecraft. This utility highlights how gold's physical properties can be leveraged for technological advancements, impacting industries far beyond mere jewelry or currency. 5. Financial crises. The 2008 global financial crisis. Example: during the 2008 financial crisis, gold demonstrated its role as a safe haven asset. As global stock markets plummeted and banking institutions faltered, investors and institutions alike turned to gold as a store of value. The price of gold rose significantly, peaking in 2011, reflecting its status as a refuge in times of financial turmoil. This behavior underscored gold's importance in providing an alternative investment option during periods of extreme economic uncertainty. These examples demonstrate the broad and varied impact of gold, from historical economic shifts and cultural traditions to modern financial systems and high-tech industrial applications. Gold's role as both a physical and financial asset allows it to continue influencing global economics, culture, and technology in profound ways. Its enduring value and utility make it a unique element in the fabric of global society. Risks and rewards of gold investing. Investing in gold, like any investment, comes with its own set of risks and rewards. Understanding these can help investors make informed decisions about incorporating gold into their portfolios. Here is an expanded analysis of the potential benefits and pitfalls associated with gold investment. Hahashar, rewards of investing in gold. 1. Hedge against inflation. Historically, gold has maintained its value over the long term, making it an excellent hedge against inflation. As the cost of living increases, the value of gold tends to rise correspondingly. For instance, during the high inflation years of the 1970s, the price of gold increased significantly, preserving the purchasing power of investors who held gold. Number 2. Diversification. Gold often has a negative correlation with other major financial assets like stocks and bonds. During periods when these assets perform poorly, gold prices may increase, making it a valuable portfolio diversifier that can reduce overall investment risk. 3. Safe haven. In times of economic uncertainty or political turmoil, gold is considered a safe investment. For example, during geopolitical conflicts or financial crises, such as the 2008 financial meltdown, investors flocked to gold, driving up its price due to increased demand. 4. Liquidity. Gold is highly liquid. It can be bought and sold relatively easily in global markets. This liquidity ensures that gold can be quickly converted into cash or other assets, a significant advantage in times of financial need. Number 5. Wealth preservation. Gold has been used as a form of wealth preservation for centuries. Its ability to hold value over generations makes it a popular choice for passing wealth from one generation to the next, especially in family estates. Risks of investing in gold. Price volatility. While gold can be a stable investment over the long term, it can also be highly volatile over short periods. Economic factors, market speculation, and currency fluctuations can dramatically affect gold prices. For instance, after reaching record highs in 2011, gold prices fell sharply over the next several years as global economies stabilized and the US dollar strengthened. 2. No yield. Unlike stocks or bonds, gold does not pay dividends or interest. The only returns on physical gold come from price appreciation, which means that if gold prices do not go up, the investor does not earn any returns on their investment. 3. Storage and insurance costs. Physical gold requires secure storage, which can incur significant costs. Safe deposit boxes, home safes, and insurance can add to the cost of owning physical gold, potentially eating into the investment returns. 4. Opportunity cost. Investing in gold can mean missing out on potentially higher returns from other investments. For example, during bull markets, equities may offer substantial growth potential, which gold investments typically do not match. 5. Regulatory and market risk. Changes in regulations or economic sanctions can affect gold prices. For instance, if a major gold-producing country like South Africa imposes new export restrictions, it could impact global gold supply and prices. Balancing risks and rewards. To mitigate these risks while capitalizing on the potential rewards, investors often use gold as a component of a diversified investment strategy. By allocating only a portion of their portfolio to gold, they can enjoy the benefits of its stability and protective features without being overly exposed to its drawbacks. The decision to invest in gold should be based on individual financial goals, risk tolerance, and market conditions. Understanding both the risks and rewards of gold investment can equip investors with the knowledge to use gold effectively as part of a balanced investment strategy. This approach ensures that gold can serve its role as a protector of wealth and a hedge against economic uncertainty without overly exposing the investor to its inherent risks. Conclusion: gold remains an intricate yet intriguing element of the financial landscape, embodying both timeless allure and substantial practical utility. For those just beginning their journey into the world of finance, comprehending gold's multifaceted role is invaluable. This understanding provides a window into broader global economic trends while serving as a powerful tool for diversification and risk management within personal finance. Expanding understanding and applications. Gold's utility spans various investment forms, each with unique characteristics and benefits. Physical bullion. Direct ownership of gold bars or coins offers tangible security. This form of gold investment allows investors a physical asset that can be held privately, providing a sense of control and security that paper assets might not offer. Gold funds. For those preferring not to handle physical storage or security, gold-backed funds, including ETFs and mutual funds, provide exposure to the market dynamics of gold without the logistical concerns of physical gold. These funds often reflect the performance of the gold price, but are traded like stocks, offering ease of entry and exit. Gold stocks. Investing in gold mining and exploration companies offers potential for significant returns if these companies expand their production or discover new gold deposits. However, this method ties returns to the success of individual companies and market conditions, introducing a different risk profile compared to direct gold investments. Strategic value of gold. Investing in gold can serve several strategic purposes in a balanced portfolio. Wealth preservation. Gold has historically preserved wealth through its ability to maintain value over time, especially important in regions experiencing currency devaluation or economic instability. Inflation hedge. As an asset that typically appreciates during periods of high inflation, gold can protect purchasing power when currency values decline. Diversification. By having different performance drivers compared to stocks and bonds, gold can reduce portfolio volatility, offering a safeguard during market downturns or geopolitical instability. Global perspective. Understanding gold's role extends beyond individual investment portfolios to its position in global finance. Countries and central banks leverage gold as a foundational asset to enhance economic stability and negotiate international trade. For example, during economic sanctions or financial crises, nations often use their gold reserves to stabilize their economies and secure international credibility. Practical advice for new investors. For new investors, incorporating gold into their financial strategies should be approached with a balanced perspective. Educate yourself. Understanding the market forces affecting gold prices, such as interest rates, inflation, and global economic conditions, is crucial. Consider your financial goals and risk tolerance. Determine how much of your portfolio should be allocated to gold based on your risk tolerance and investment timeline. Seek professional advice. Consulting with financial advisors who understand gold investments can provide personalized insights and recommendations. Empowering new investors. This beginner's guide is designed not only to educate, but also to empower new investors. By highlighting the practical uses and strategic importance of gold, it encourages informed, confident decisions about incorporating this precious metal into diversified investment strategies. Gold, with its unique properties and historical significance, offers a special opportunity for securing and potentially growing wealth in ways that other assets may not.